Hello and welcome to Market Domination. I'm Jared Blickery in for Josh Lipton, who is snowed in today. There's just an hour to go until the closing bell, and stocks are plunging as investors grapple with the fallout from fresh AI jitters, as well as the Supreme Court striking down President Trump's sweeping reciprocal tariffs, which has thrown major trade deals into doubt. And let's get a quick check of the markets here. Generally risk off today. We also have a winter snowstorm in tow, and we got the Dow down about 800 points or 1.62%. Heading to the NASDAQ, it's down about 1.38%, and then the S&P 500 off a bit less than that, but still just a little bit off of its lows. Has not been a pretty day for the tape. And heading over to the bond market, we got the 10-year T-note yield down 6 basis points. That's a pretty big drop there to 1.3 to 4.03%. Getting pretty close to that big 4 handle right there. And the 30-year T-bond yield, that's down 3 basis points to 4.70%. Well, we want to get to our main story of the day, and this is President Trump announcing a new global 15% tariff rate after the Supreme Court ruled to strike down those reciprocal levies put in place on Liberation Day. But what does this mean for the trade deals that have been made since then? And what about all that tariff revenue that has been collected? Yahoo Finance Washington correspondent Ben Warshkull, he was on, broke it down for us earlier this morning on Morning Brief. Let's take a listen.
This 15% tariff that Trump announced over the weekend has a time limit here of 150 days. That gives us sort of until late July, where this new blanket rate of 15% will be in effect. It actually doesn't formally go in effect till tomorrow. So it's from the 24th of this month until July 24th, where this new rate will be. It's a new kind of one-size-fits-all approach from Trump to kind of replace these varied emergency tariffs that were struck down last week, and have created some clear winners and losers at the national level. But the overall direction here is a tick downward. The estimates here are that these new 15% tariffs will bring in about 70% of the revenue that the IEEPA tariffs, the ones that were struck down, would have brought in over this 150-day span. That's according to the Tax Foundation. And in an overall rate here, going from 16% to 13.7% once these new tariffs are in effect. So a slight downtick, but there's a bunch of countries, especially in Europe, I would note, that are protesting because they're kind of losers in this, and they could see their rates increase.
Right, because basically they had the framework of the trade deal with the US, right? The EU, for example, other countries as well. And there were certain things that weren't subject to tariffs at all. And so do we even know yet how the new rules are going to affect those items?
Most of the items that had their own tariffs before that were either excluded from tariffs or had their own rates, those are unchanged. Automobiles, semiconductors, pharmaceuticals, things like that. They have their own tariff authority. It's called Section 232 tariffs, and those are unchanged, and those are excluded from this 15% blanket tariffs. I'd also note that USMCA goods, trades between Mexico and Canada, have a lot of excluded goods, which are also excluded from these 15%. That's why you see a 15% global rate, but the effective rate is lower than that, about 13%. The countries that are having a real problem with this are the ones that struck kind of the best deals going forward. The United Kingdom is the major one here. They were first out the gate. They were praised by Trump and his team for negotiating early, negotiating often, and they're the ones that could see their overall rates increase the most in the when these go into effect this week. Europe is in a similar boat, a sort of 1% increase in France and in Italy and countries like that negotiated a lower rate, and I would add offered the most concessions early on to kind of get a lower rate. On the flip side of this, perhaps ironically, some of Trump's biggest antagonists in the trade world, China, Brazil, Mexico and Canada to a certain extent, are going to see their rates decline. Brazil is probably the most stark example. Their rate is expected to be more than half because a lot of Trump imposed emergency tariffs there on a variety of issues with Brazil. So those are gone. Similarly with China, US, Canada, and Mexico over fentanyl. Those are all wiped away, replaced with this 15% tariff. So they're going to be lower, even though they're the ones that have kind of sparred with Trump the most over the last year.
And Ben, one of the other big questions is whether companies who have paid tariffs are going to get their money back, right? And this is something that legal experts seem to say, according to the Supreme Court, they should just get their money back. But the Trump administration has indicated they're going to have to fight for it.
Yeah, I think there's a widespread agreement. Trump's formulation here that he offered Friday is that it's going to be about 2 to 5 years of litigation here. That's how he put it on Friday. And I think that's the widespread expectation here of sort of how this tariff refund process is likely to unfold, with a lot of legal wrangling and a lot of legal costs, I would add. It's notable that Trump and his team could simply set up a tariff refund process. They have the power to do that. That would be the kind of assumption here, but they're clearly not interested in doing that. They're kind of throwing up their hands, saying that this is up to the lower courts to decide, which means a whole lot of different lawsuits going back and forth here. I think it's going to set up a real calculation here for companies about whether this is the cost benefit analysis here. This is years of litigation. This is years of cost to get this money back. And so there's a lot of questions here about how many companies are going to pursue it. Some already have. Costco is an example of a country that preemptively filed a lawsuit to get here, so they could be kind of early in line for refunds. But it's clearly going to be a long process. There's no checks going out this week, this month, even is expected. It's going to be a kind of drawn out process where basically the Trump administration bites tooth and nail as much as they can. That's what they're signaling. And the companies try to get as much as they can through legal means here.
And as President Trump doubles down on his tariff regime, uncertainty is dominating the market. Major averages still in the red. And let's take a deeper dive with Melissa Brown. She is the SimCorp Managing Director of Investment Decision Resource. And thank you for joining us here today, Melissa. What a day. I mean, take your pick. We got this winter storm. We've got AI jitters fresh off this weekend report. We can get to that in a minute. But I think tariff threats are top of mind for a lot of investors. So kind of walk us through the latest, please.
Well, don't forget there's also some geopolitical issues like with Iran. So that was not an exhaustive list. But I think, it was interesting that the tariff announcement came on the same day as a kind of mediocre GDP growth and a higher than expected PCE number, the inflation number. And so I think on Friday, things, kind of got a little bit muddled together. And maybe today investors are really more starting to sort out, what's what. It is interesting to see that this tariff threat has, been there, that not just a threat, the actual tariffs have been kind of in effect for a while. And there may be some changes in the numbers, but the market has not seemed particularly things settle down. So I would expect that they're going to settle down again. And the focus may go back onto this, potentially stagflationary environment.
Melissa, is it possible to game out some of the winners and losers here, given all the variables? Any insight you can provide there?
There's certainly, I think it's harder actually to tease out the AI trade winners and losers, and some of the other economic winners and losers. The tariffs, as you mentioned, some countries are going to see maybe higher tariffs than they had originally negotiated, and so we might look at some issues for those countries and other countries where perhaps they're actually going to come in lower. But there's still so much uncertainty that I think it's difficult and possibly unwise to try to figure out who the winners and losers are right now. I think we have to see things calm down before we can determine, at least from the tariffs, who the winners and losers are.
Well, let's talk about some of that volatility for a second. I'm looking at the VIX. It's at 21.4. It's near the highs of the year, and that is signaling that there's an institutional bid for protection. This is a gauge of 30-day volatility based on the options market in the S&P 500 options. And so this is elevated versus history a little bit. It's not to extreme levels. But what does this tell you as an investor? Are you retrenching a little bit? Are you going to cash? How are you playing this?
I think we actually, even before last Friday, had started to see some of this retrenchment. I mean, investors were moving, I think, out of the U.S. into other countries. I think they were moving into lower lower risk kinds of stocks, lower risk kinds of sectors. So moving from the AI trade, which was, generally higher volatility kinds of stocks, moving into lower vol names. And so I think that retrenchment was starting already. VIX is up, but as you say, it's not really up that much if we compare this to like Liberation Day. The VIX,
Yes.
Is still relatively muted. So, I think uncertainty has increased, but, it hasn't gone crazy yet.
Well, let's shift to earnings a little bit because we're not out of the woods there. We got NVIDIA coming up, of course, the poster child for the AI trade. And we saw some fresh news over the weekend. This was a report by Citrini Research, and we don't have to go into all the details, but it has revived all the SaaS-pocalypse fears. That is, that software companies that expect recurring revenue are just going to be edged out by AI. Nevertheless, NVIDIA, still a picks and shovels trade right there. What do you expect from NVIDIA in their earnings?
Well, I can't comment on individual companies, but I think more broadly, we are kind of past the hyper enthusiasm about AI writ large, and I think we're at the point where we really are starting to sort out the losers and the beneficiaries. I'm not sure we're there yet. But I think there are, some companies that as long as there is, as companies are adopting AI and using it more and more, there certainly are some companies who will be benefiting from that.
Well, let's talk about some of the plumbing in the markets, specifically Blue Owl. And this is a company that has been involved with debt raises for Meta, for instance. And this raises the issue of private credit. This is an industry that's grown into trillions of dollars over the last decade from a very much smaller number. Is there a canary in the coal mine here? Is private credit something that we're going to be saying a year from now, well, we should have been worried about this in 2026?
Private credit is something that we've been worried about for a while. I think, the Blue Owl announcement was, the most recent cause for concern, but we're seeing, stocks of companies who are involved in private credit have been kind of steadily going down for months now. It certainly is potentially the canary in the coal mine that, there is a problem with this whole private credit industry yet. That doesn't quite seem to be the case yet, but we may look back on that announcement and say, okay, that was the turning point. I'm not willing to throw in the towel just yet, but it's something that I think needs to be watched very closely.
All right, a day of ominous signs here. Really appreciate your time, Melissa. Thank you.
My pleasure.
And coming up, how tariff policy changes impact furniture companies. We're going to be talking with the Ethan Allen CEO coming up. The U.S. now lifting the baseline tariff rate on imports to 15%. This follows the Supreme Court's decision to strike down President Trump's most sweeping tariffs. But with uncertainty lingering, we're now looking at how this fares for home furnishing companies such as Ethan Allen Interiors. And joining us now is Chairman and CEO Farooq Kathwari to discuss. Thank you for joining us here, Farooq. We got to start. Yes,
it's a pleasure, first of all. Yeah.
Oh, I appreciate that. We got to start with the big story here because we are not short on news today. Supreme Court striking down the Trump IEEPA tariffs on Friday, and we got some escalation over the weekend, shall we say. What do you make of this decision, and how does it affect your company here?
Yes. We've been around for 94 years. We are a vertically integrated company. From manufacturing, retail, logistics, we have the largest interior design network. About 75% of our products are made in our own facilities in North America. 45% are about in the United States, and about close to 20% in Mexico, and about 10% or so in Honduras. So North America is a very important part of our operations. 20 years back, it was all the United States. We felt that it was important for us to diversify, but instead of going, let's say, to East Asia, we decided to go south of the border. Now, the surprise was that we had these big tariffs, both in Mexico and in Honduras. Interestingly, I was just looking at it that while the tariffs have been reduced, but the tariffs for instance, for Mexico are still at 25%, and Honduras has gone from 10% to 15%. They've increased the tariffs for where we are doing business and reduced a lot in other countries. Having said all of those things, that we are, as I said, fortunate that we do have a very strong presence in the United States. We have we operate it, we manage it, we don't buy the products from others. So we have been impacted, obviously, with these tariffs. And I would think that as we move forward, that there will be a reduction of tariffs right here in North America.
So I have a question then. How did these tariffs that were enacted 1 year ago, how did you respond to that in terms of your pricing, and then what did it do to your margins? And then I guess looking forward, how do you expect this to play out for your company over the next year or so, given what little information we might know right now?
Yes, it did have an impact. But again, as I said, the majority of our manufacturing is still in the United States. We had to work in terms of taking some price increases, but not to the full extent of the impact of the tariffs. So it affected our margins. And I think as we go forward, we want to, on one hand, make sure that we have decent profitability, but on the other hand, we have to also remain competitive. So we're going to continue to do that. We are fortunately a company that we've always been profitable. We'll maintain the profitability, and our vertical integration helps us. If we had to buy the products from others, then it sort of, we would not have the flexibility. We do have the flexibility of making the determinations of how much will be made in the United States, how much will be made in Mexico, how much will be made in Honduras, and how much will be made in other parts of the world. Interestingly, these tariff reductions, the greatest reduction has been on China. Interestingly, with all the challenges we have, I would have thought that our partners right here in North America, that's where the tariffs should have been reduced, but that did not happen. So we will continue with what we are doing because of our structure. And we have to be careful that we make sure that we are competitive. And again, as I said, a vertical integration helps us.
Yeah, I got one more quick question here, then we can move on. What about the refund wildcard? Would Ethan Allen be in line for any refunds should those be issued?
Well, yes, of course. In fact, not only that, I was just hearing from my team members that there are now businesses that are offering to buy that at about, I think, a 50 or 55% discount. They'll give the money, and when it comes, they'll get it. Now, of course, we'll look at it, but I don't think we'll do that. We'll wait, because we believe that if they are going to give it back, we should get it back 100% and not share it with others.
I hear you. I want to switch over to AI and the impact. You mentioned you're vertically integrated. You do your design in-house. How has AI impacted your business, if at all?
No, absolutely. I would say overall AI and technology. I think that today it has impacted in everything we do. For instance, our manufacturing. We have a very strong presence in Vermont, in North Carolina. We used to have 20 manufacturing plants all over the United States. Now we have 2 major locations in the United States, and then we have, as I mentioned, Mexico, for instance. We went there 20 years back. We bought a 50,000 square foot plant. Now it is 600,000 square feet. In Honduras also, we have about close to 250,000 square foot plant. Technology has played a role in everything from manufacturing. And our interior designers, we have 1,000 interior designers. 10 years back, they were close to 2,500. With technology, we are able to have less people and be very productive. And so, for instance, our advertising. We are today able to send 2 magazines a month, 36-page magazines a month, produced in 2 weeks. Used to take us 2 to 3 months to make one. So technology and this has tremendously impacted everything we do. Our interior designers today are able to work with clients, whether in our design centers or in their homes. Certainly, our manufacturing is tremendously impacted. Our retail is impacted. Our design is. So we have, as I said, half the people today doing more business.
That is an amazing reduction. And Farouk, we got to leave it there because of time, but really appreciate your insights and stopping by here. Thank you.
Okay, very good to be with you. Thank you.
And coming up, Paramount reportedly looking to up its bid for Warner Brothers Discovery. We're going to discuss the potential fallout next. Don't go anywhere. Paramount reportedly gearing up to make its best and final offer to take over Warner Brothers Discovery. Variety is reporting Paramount will raise its bid to $32 a share before the Monday deadline. And joining me now is Sean McNulty from The Ankler. Sean, thanks for joining here today. So Variety reporting that this revised offer from Paramount could be around $32 in the stock. I noticed that WBD is trading just south of $29 right now. But what do you think? Does this get the deal done?
The question Hollywood has been waiting to find out, and we have a midnight deadline tonight. This is kind of a Groundhog's Day here. Will this deal finally materialize? It's been at $30 a share since early December, and there's been word around town that they have to get their offer up. Some have said $33, some have said $34, so 32 is the new magic number we've heard reported today. That's in the eye of the WBD board. If this gets it to be a superior proposal to the Netflix deal, which they have already agreed to.
Yeah, could Netflix come back? I mean, I guess they could, but is there any chance of that at this late hour?
That's also the interesting question is, will Netflix fight for this? Netflix has been on record saying they don't need WBD. They like, the deal that they have, and they like it at the price that they have. Will they like it if they have to go up to, say, $30 a share? Remember, these two companies are bidding on different assets. The cable business is not part of the Netflix deal, so the numbers don't exactly match up, apples to apples, if you will. So Netflix has the money. They have their debt rating is fantastic. They have access to to lenders. They could put more Netflix stock into the deal again. So they have a lot of options if they want to play. But at some point, the Netflix stock's been down quite a bit since this deal's been announced. Will the shareholders punish them more if they end up spending more money, which is a legitimate question for Netflix to consider?
Yes. Do you think it's a good deal for Netflix?
As of now, yeah, they're getting a lot of great IP. They're getting HBO, one of the most important television brands of all time, under their umbrella. They like the price they're paying is leaving them with at a very good leverage point, so they're not going into heavy debt to do this deal, as opposed to P-Sky, which is going to very heavy debt at the outset of this deal, if in fact they do get the deal. So it's a nice win for them. The regulatory question is out there as well. The government let them do this deal, but to bring in Harry Potter, Lord of the Rings, HBO, all the great IP that WB has, and the big TV studio, it's a great combination for them to solidify their dominance in Hollywood these days.
Well, some analysts, including some on the show, have said that for the Ellisons, and this is the Paramount team, this is a must deal. This is a must-do deal for them. Do you agree with that?
Yeah, I mean, Larry Ellison didn't, presumably come to Hollywood to become, the fifth or sixth player in Hollywood and stay there. So if they want to become part of the top 4 tier of Hollywood, so Netflix, Amazon, Disney, there's a fourth slot kind of open there. They need this asset. There's nothing else in the marketplace that gives them the scale in the US or globally to put them in that club for the next 10, 15, 20 years of this business. So if they don't have that, their other option is really to invest in their business, which, growing new properties, growing new IP, which just takes time and money. You get some new sports deals coming up. You can add in the MLB, NHL, things like that. But that's going to take time and money. This is a one-stop shop to get you into that pantheon. So yeah, they need this. There's nothing else out there outside of NBCU, which is debatable as whether Comcast wants to part with that. They have not given any indication that that's the case so far. So yeah, this is all that's left on the table in Hollywood.
And what about the regulators? The Trump administration has kind of weighed in on this deal. What might the pushback from regulators be if Netflix makes another last bid offer? Game that out for us, please.
Yeah, so the DOJ is reportedly, adding in a kind of an antitrust monopolistic investigation into the deal that is on the table at this point. It's just, again, investigating at this point. No formal case has been brought. That's still a ways to come, if that is to come. It's a looming question, and honestly, it's going to be up for a judge to decide in the end, not a politician or not, a Wall Street analyst or what have you. Remember the AT&T Warner Brothers deal? That did get a lawsuit, back in the late 2010s, and it just played out over a long time. It, passed, it happened, but it just took, year and a half, 2 years longer than either side probably would like there. And that's the danger of this deal, is that this deal, if it gets a lawsuit from the DOJ, the closing of this deal could linger on to late 2027, maybe even 2028, depending on how this goes. And that's, for a shareholder, you want your money sooner than later. And if you're going to be tied up in a lawsuit, that's what they have to weigh here, the risk of that.
We got about a minute left here. Anything we didn't cover on these three companies that you'd like to add to the discussion?
At this point, it's, the Hollywood of it all is an interesting point of view on this, and that, either side of this has a lot. There's no perfect deal here for the people of Hollywood, in the sense that the Peace Guy deal represents, a lot of job loss. As I said, they're going to have a lot of debt that they're going to need to pay off in a very quick amount of time. And the only way to do that, one of the main ways to do that, is just to cut costs. And that's going to be a big problem with the Peace Guy deal. If the Netflix deal comes in, there's a lot less job loss coming in, but you're going to have a very big consolidated buyer. So if you're a producer, if you're talent, it's one less place that you can kind of go to create a bidding war for your great script or movie proposal or whatever it might be. So that's kind of the net of the side of it. But a lot's riding on this this deadline tonight, and we have a March 20th shareholder vote. And at which point, if that's approved, then Discovery Global will probably be spun off out of Warner Brothers sooner, and further make it a lot harder for Peace Guy to even come in, because they want that cable biz money as part of their deal. So the March 20th deadline is the next thing to really keep your eye on. And the Versant earnings call, which happens on March 3rd next week, which kind of is maybe a check on the valuation of Discovery Global, which is a big point of contention in this deal. So we'll get our next indication from Wall Street on that on March 3rd.
Yep, and of course the deadline at midnight tonight, and I'm sure we'll wake up to some fresh news tomorrow. Thank you for your time here. I appreciate it so much.
Happy to be here.
And oil prices remain elevated as tensions in the Middle East between the U.S. and Iran are escalating. Meanwhile, the harsh winter has sent natural gas prices higher. Rebecca Babin, CIBC Private Wealth Senior Energy Trader, joined Julie Hyman this morning to cover all of this and more.
So for natural gas, really what we're seeing is we've had a very severe winter, as you mentioned, not just in the US, but across the globe. It's been significantly colder. So we've had an increased demand pull, while at the same time we've had freeze-offs that took place in January due to the cold weather. So it was a kind of a impact where in January we had this massive demand spike with a supply withdrawal, and we saw that huge rally in nat gas. That has since reverted back to around where we are at the moment at $3 Henry Hub. But at the same time, we're super weather dependent, and demand obviously increases during these periods of the storm. I think also a consideration here that shouldn't be completely ignored is the geopolitical factor for gas and LNG. The Strait of Hormuz does carry 20% of the world's oil, but it also carries a decent amount of LNG through the strait, which can impact European gas prices, which has a knock-on effect to U.S. gas prices. So there's a lot going on. Most importantly, it is weather related. It comes down to how much demand we have due to the cold weather and how much supply is impacted. And then there's the kind of undercurrent of geopolitics in the background as well.
Gotcha. And this time around, at least, it's not expected to stay as cold for as long. So hopefully that will, be a little bit of an easing pressure for prices. So you mentioned geopolitical and what could be going on in the Strait of Hormuz. How are you thinking about this, and what, because we don't know exactly what a strike on Iran could look like, even if it does happen. So how do you sort of game out the various scenarios?
Well, I'll tell you this, the crude market has been in a headline blizzard since the start of the year. So we've had tough weather to deal with in real life, and the crude market certainly is feeling the same. So when we think about the Strait of Hormuz, obviously this is an extremely important choke point for crude oil transit, not only for Iran, but for Saudi Arabia, UAE. And it could have a meaningful impact on crude prices should there be friction within the strait. It doesn't need to be entirely closed to create a spike in oil prices. There just needs to be the fear of a potential attack, similar to what we saw in the Red Sea with the Houthis. Now, this is a very low probability by the market's estimation that we do see the Strait of Hormuz come into play. It's a non-serial event that has a major impact on prices. So although we see a less than 10% chance that the Strait of Hormuz is impacted due to this conflict, if it were, the impact on prices would probably be in excess of $10 to $15 in crude price. So when we think about it, even though we don't think this is this event we don't think this is the direction that either side really wants to head towards in terms of causing a conflict that involves the Strait of Hormuz. If it does, there's a real impact. So you have to kind of take into consideration what that means. And what it means is Iran is no longer able to export as many barrels to China. What it means is Saudi Arabia isn't able to export as many barrels to China, and China's likely going to be a bit frustrated by that. So keeping that in mind, that's why the probability of a Strait of Hormuz event is so low, is that it impacts so many other countries globally, and it brings other countries kind of into the fray of this conflict, which I don't think serves potentially Iran or the US. So low probability, high price impact. If we look at military action, we might be looking at something that targets either military bases or along those lines before we get to a Strait of Hormuz event.
I mean, what's interesting too, Rebecca, is that if you look at the background of the oil market, for example, Goldman Sachs, the commodity desk over there, just raising its price targets for Brent and WTI, sort of ex-Iran. And indeed, we've seen this rally this year in oil prices that at least not a lot of people I was talking to were expecting, because it looked like we had a lot of supply out there. So what happened this year that kind of changed that scenario?
So that's a great point. And Goldman's not the only one raising their target this morning. Morgan Stanley did also, again, ex geopolitical events. And I think this is the setup. Everyone was expecting 2.5 to 3 million barrels of surplus coming into 2026 for the first quarter, at least, if not for the whole year. That's a pretty extreme number. What we've seen is the weather that we just discussed for nat gas also impacted crude production in the US. We had Kazakhstan have a fire in one of their power plants, and that impacted crude supply. We've had the CPC pipeline that was supposed to be coming back up in early January delayed. So we've had a supply event outside of geopolitical risk that has taken supply down, and demand has actually been fairly robust. Cold weather, more demand for heating oil, etc. So the surplus that everyone had been pricing in to get to those price targets in the mid 50s, which is where they were before they raised them this morning, you needed to see those inventories really building. And the inventories just haven't been building in the OECD centers. There is a lot of crude on water. But if we think about that, is that really something you can translate into feeling like that's inventories that can be drawn on quickly in an event to meet a demand spike or, a supply gap? Not necessarily. And then the other thing is China has continued to stockpile a lot of crude at the start of the year, keeping those surpluses out of the visible inventory centers. So that's why we're seeing those price targets come up. But the bearishness was so pervasive, Julie, coming into the start of the year, that I'm not surprised we're seeing that. And $60 targets are not extremely high. 55 was, I think, kind of an over bearish estimation coming into the start of the year.
And coming up next, we look into that critical NVIDIA earnings report on market domination.
Welcome back to Yahoo Finance. I'm Brooke DePalma. Let's take a look at some of today's top analyst calls on Wall Street. Today, we're watching Google's parent company, Alphabet, as well as cereal maker General Mills, and also the real estate company CBRE. Let's take a look at how those three stocks are performing as we make our way towards today's trading session close. First up, Google's parent company, Alphabet, Wells Fargo, upgraded the stock to overweight from equal weight, calling it a, quote, winner in AI. The analyst said three qualities of the search giant that put it on the leaderboard include customer data, distribution, and compute capacity, all of which are helping it get ahead of other hyperscalers. Wall Street, though, very bullish on the stock. Alphabet stock has 70 buy ratings, 8 holds, and no sells. Next up, let's take a closer look at General Mills. Bank of America downgraded the cereal maker to neutral from buy. The analyst said its turnaround potential has now been pushed out further as recovery in consumer spending has been slower than expected, especially for lower and middle income households. Wall Street still mostly on the sidelines with this one, despite this pop today, with 4 buys, 15 holds, and 4 sells. Lastly, let's take a look at the real estate company CBRE, because UBS upgraded the stock to buy from neutral. The firm thinks that worries over the impact of AI, they say they're a bit overblown there. The firm said the company is well positioned to benefit, saying the stock has room to the upside. It also expects leasing and capital markets revenue to grow both 13 and 12% based on industry trends, as well as CBRE's fiscal 2026 guidance. That stock also well liked on the street with 12 buys, 1 hold, and 1 sell. Keep right here on Yahoo Finance. We'll be tracking all latest market moves and top calls throughout the trading session.
And NVIDIA is set to release results on Wednesday as AI disruption fears swirl through the markets. Antoine Chukabin, New Street Research Technology Infrastructure Analyst, joined Julie Hyman this morning to discuss what we can expect from these results.
The demand signals are very strong. We've seen, like hyperscalers getting up CapEx very significantly. That resulted in material revisions to expectations. On top of that, you have OpenAI now who's increasing their revenue projections. That also means they're going to spend more cash as well. The forecast, I think, was increased by like over 2x. Now, I think you're going to have, this year supply constraints, very strong supply constraints across the board. In particular, memory is in very tight supply right now. GPUs need a lot of that memory. And I think investors will likely be watching out for any details, on how this could impact shipments and potentially margins as well this year, because memory is getting more expensive. So the bottom line here is that, we expect NVIDIA probably to grow revenues mid to high teens sequentially every quarter. This year, that's about in line with expectations. And whether NVIDIA can grow faster than that, I think will depend mostly on how much supply NVIDIA can access, how they're able to navigate, these supply chain bottlenecks.
I mean, it's interesting. This has been sort of the narrative with NVIDIA for quite a while now, right? That demand is not an issue at all for as far as the eye can see. Supply has mostly been the only constraint. Is there any change of that expected? Do you think, I know that you wrote in a recent note that you think things will be strong for NVIDIA in 2026, but 2027 could see stabilization. Does that imply that demand will moderate?
Yes, I wouldn't call that a stabilization either. I think NVIDIA can still grow, beyond 2026, especially, if their shipments are limited by supply this year. That extends potentially the current cycle. But I think it's more about the growth outlook, because even in such a dominant position, NVIDIA will have to make room for alternatives. And that's also weighing on the stock, with chips like Google's Tensor processing units gaining a lot of momentum lately, not just for Google, but also for Anthropic. Even there were some reports that Meta would use the chip. I think the question is how much of NVIDIA's opportunity will be taken by ASICs, by these dedicated chips. And so even if the stock is relatively cheap, it's trading on 20 times 2027 earnings, and if you compare that, to the multiples that NVIDIA has traded on historically, it's quite cheap. But I think now the question is really the pace at which NVIDIA will grow in 2027 and beyond if they make room for these alternative chips, and whether that growth will be enough to justify a re-rating.
Something else I wanted to ask you about, Antoine, is China sales, because for a good while there, analysts like yourself and your peers were just saying, not even counting any China sales in their models, right? Because it didn't seem like it was necessarily going to happen. And I've started to see some analysts maybe start to bring that back in. What do you think that picture looks like?
I think China will probably remain a source of concerns, a source of volatility in the stock. I mean, right now the situation is that H200 exports are not like forbidden for all customers. You can have like a case by case review by the administration, I mean, and of course, by the way, the administration is going to charge like 25% tariff, paid directly to the United States, for these exports. But I think, at that point, it will we don't have certainty on whether Nvidia will be able to keep shipping those chips. Now it's on the Chinese side as well, where the Chinese authorities are requiring Chinese firms to match their Nvidia purchases, with local AI chips as well. So I think, the situation will remain very volatile. And even if, China is a very big opportunity for Nvidia, like it used to be 20 to 25% of their revenues historically. Jensen talked about like a 50 billion opportunity. I don't think, we should bet too much on those revenues.
So, Antoine, given that we've seen Nvidia underperform other chip stocks, if you look at the Philadelphia Semiconductor Index, it hasn't done nearly as well as the broader group has this year to date. And given that we're used to like sort of big pronouncements from Jensen, right, and big predictions, is there any like kind of magic thing that he can say in this earnings report that would cause the stock to take off again?
He's already said a lot.
Right.
Last year he was talking about a 3 to 4 trillion opportunity, for AI infrastructure, for data center infrastructure, capex by 2030. So that still implies a lot of upside, and the street, didn't give him much credibility for that. The stock didn't really react that much on these comments. And so I think at that point, it's really about execution. It's about wait and see. It's about whether they can maintain their highly differentiated position with their GPUs, which are more flexible, which have a very strong ecosystem, while at the same time we're starting to see very strong momentum from these other chips. And so now, what happens in 2027, I think it's still a bit early to tell, and I don't think he can say much that will reassure investors.
We are wrapping up today's market domination, and stocks are still sinking as we barrel to the close. You can see the S&P down over 1%, Dow off over 800 points, and the NASDAQ also down over 1%. Do not go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime. Hello and welcome to Market Domination Overtime. Let's get a quick check on how the markets closed the day, and we'll start off with the Dow here. It is down 861 points, or about 1 3/4%, ominously closing at about the lows of the day. You can see that on your screen there. Here's the NASDAQ Composite down 1.2%, a little bit less, despite the fact that software got absolutely whacked today. We'll investigate that in a second. And the S&P 500 also very close to the lows of the day, down 1.15%. Meanwhile, the S&P 600, that small caps, that was down over 2%. So some of those smaller issues taking it on the chin. In large cap sector land, I'm looking at a few winners here. It wasn't right across the board. Consumer staples, which is defensive play, along with healthcare, those were each up more than 1%. Then you've got utilities up 0.7%, energy and real estate, but that is a broadly defensive trade right there in the green. To the downside, financials were leading down 3.4%. Second to that, we've got consumer discretionary. That's your retail trade, as a lot of shops closed today because of that winter storm that we're experiencing here, as well as tech. That was down 1.8%, and industrials, communication services, all of those down 1 to 3%. And I think the Dow and the components really telling an interesting story today. We got a report over the weekend about the potential for the AI scare trade to evolve over the next few years. And we're going to be talking about that in more detail in a minute. But Microsoft down 3%, Salesforce down 4%, IGV, that is a software ETF, was down the most since April of last year. That was that post-Liberation Day sell-off. And meanwhile, I said financials were leading down. JP Morgan down 4%. And then the payments processors, that was part of the same Citrini report. Guess what? They might be disrupted as well. And so American Express having its worst day in quite a long long time, down 7%, and Visa down 4.5%. And also another financial for you, Goldman Sachs, that was down 3%. And then in retail land, we can't forget about the tariffs. Guess what? Nike down 3.5%. So you put it all together, and there was not a lot of green inside a lot of those risk-on soft sectors that we like to talk about. And just getting to some of our other sentiment indicators here, biotech in the green along with solar. But what's really catching my eye too is crypto. Bitcoin down about 4.5% since 5 p.m. yesterday. Over the last 24 hours, it's down 4.34%. Also seeing pretty steep losses in Ethereum, Solana, that's down 5.5%. Bitcoin Cash down 13%. And so that list goes on. But not everything in the red, as I said. We also have silver and gold popping today. Gold, I think, is at a 1-month high, up about 3.5%. Meanwhile, silver also at a multi-week high. That is up 7.5%. So you put it all together, and kind of a scary day on the tape in a lot of areas, but a little bit of green, if not only in some of the defensive trades there. So moving on, while investors digest changing tariff policy, the next key catalyst for the markets this week is NVIDIA's earnings out Wednesday after the close. So how can we expect markets to react to these results given the recent slump? Joining me now is Mike Bailey, FBB Capital Partners Director of Research. Mike, what a day here. Thanks for joining us. So let's tackle NVIDIA first, and we can get into some of the other big movers here.
Absolutely. So yeah, NVIDIA is definitely the big one for the week. So that is the question. Is NVIDIA going to be sort of the period at the end of the sentence we've seen with the earnings season? It's been pretty mixed so far. I think for us, there's two pieces. There's the fundamentals, what's going on with the company, and then what is sentiment? How are investors kind of baking in some of this growth? On the fundamental side, things look pretty good. So most of their big customers, Microsoft, Amazon, Google, et cetera, they're spending a ton of money. They've already reported how much they've spent on CapEx chips, how much they're planning to spend for this year. So that looks pretty good. So we feel generally pretty favorable in terms of NVIDIA for the quarter and even for the guidance, feeling pretty reasonable there. I think the real question mark is sentiment. So trying to kind of get ahead of that, just take a quick look at the stock. NVIDIA stock has been right around with the market for, let's say, 3 to 6 months. To us, that suggests investors really don't have massive expectations built up for the quarter. So if it's an inline quarter, if it's reasonable, maybe they beat and raised a little bit. To us, again, the stock's not moving a whole lot ahead of time, probably not a massive move. So that's sort of what we're looking at, as we get just a day or so ahead of earnings. We'll see what happens, but that's sort of our best guess as we look at sort of the last major company in this cycle of earnings.
Yeah, and so that's the chip trade. And then in tech, of course, we also have the software trade that has gotten obliterated, decimated, let's call it decimated over the last 6 months or so. Since September and October, that's a lot of when a lot of these big stocks top. We got this report over the weekend from Citrini Research, and I don't know if you've had a chance to look at it, but I'll summarize it real briefly. The core claim is AI could make a lot of software feel more like a commodity. It's easier to copy, harder to defend, less pricing power, and the fallout is that investors are using that as a simple reason to de-risk in a lot of these high multiple names that have already been hit. So we saw this hit take place in software. We saw it take place in payments. That's American Express and Visa. Separately, IBM got whacked because of some comments by, I believe, Dario Armodi over the weekend. And so what do you think of the software space right now?
Oh, it's brutal. It's very challenging. I think for fundamental investors, typically we try to look for stocks that chase earnings. Over time, companies grow, they generate a stream of profits. Stocks tend to follow that. That's sort of the bread and butter approach for many stocks. However, a little bit of a different situation now. So the question is, instead of looking at what is the company going to generate in profits this quarter, maybe this year, for software, investors want to know, how about the next 3 years? How about the next 5 years? And frankly, It's a giant question. We really don't know. At this point, it does seem that some of the selling could be a bit overdone. Investors are really just anticipating these massive declines and lost market share, just really lost volumes. We'll see. It really is going to take time for companies just quarter after quarter. What does demand look like? What does their guidance look like? It's really going to take some time to come back from that. But it does feel like, if you go back to kind of behavioral finance, are some of these stocks going from, frankly, flawless, perfect a year ago to hopeless? Kind of feels like we're somewhere towards the negative end of that extreme now. So maybe there's a recovery, but it's going to take some time for companies to really come out and generate that growth and kind of push back on the bears.
Yeah, hopeless is actually sometimes a good thing for the bull case, but a lot of times you got to wear out the bulls, and that could take a while. We got a lot of news to get to. So tariffs, on the tariff front, we've talked a lot about the Supreme Court rolling back those Trump tariffs in the IEEPA, but then Trump over the weekend saying he's going to institute those 10 to 15%. How do you think this plays out?
Yeah, I mean, I think we're seeing a little bit of it today. So I think the main takeaway is just increase in uncertainty. Not massive uncertainty, nothing close to what we saw, almost a year ago with Liberation Day. But I think investors really crave, okay, just give us the rules. What's the playbook here? And over the weekend, and including Friday, we just took that rule book and ripped it up a little bit. So I really think, kind of compare and contrast this level of risk. What are tariffs going to be? Compare that to the software discussion. In other words, is this business going to be alive or dead in 5 years? It's very different. I think it's an order of magnitude different. But for companies, especially those that still import a lot of products, it is an issue. And I think we've seen over the past 8 or 9 months, companies tend to be very flexible in finding ways to adapt. I would expect that to continue. However, we've got a new risk factor. Stocks typically take a slight leg down as you get more uncertainty. We're seeing a bit of that today, and we'll see. We'll see how this plays out. But I would expect additional news back and forth on the tariff issue over the next weeks and months.
So let's talk about the reaction function at the Federal Reserve. That's another wild card, but at least maybe a little bit more predictable, except that we also have some more wild cards at the Fed coming. We got a new chair coming in May. We've got the Lisa Cook decision in the courts. What do you see the Fed doing this year?
Yeah, great question. We're just going from one volatile sector to the next here. Keep it
Right.
interesting. I think the base case with the Fed, for a lot of reasons, is really just holding tight, right? Not taking a lot of action. Frankly, until the new Fed chair comes in, I think investors are looking for probably the next rate cut in June. So there will be a new Fed chair at that point. That seems like a good mainstream approach. I think it would take a significant change in something, meaning the job market or inflation, to really throw that off. So what's happened in the last 72 hours? We've got a new risk factor on tariffs, potentially slightly higher inflation. So that does, I think, suggest maybe a delay to that rate cut. But we'll see. A lot's going to happen between now and June. But that's probably the base case in terms of major upcoming events for the Fed in terms of the next rate cut.
All right, we got a lot in there, so thanks for your help, Mike.
Absolutely.
And coming up next, we look ahead to President Trump's State of the Union address. That's coming up too on Market Domination Overtime. We've got 3 mega IPOs on deck this year, and now Elon Musk's SpaceX story has a new twist. Its IPO advisors are reportedly looking into getting the space giant into the major indexes like the NASDAQ and S&P 500 a little sooner than usual, which would in turn virtually guarantee billions in stock purchases after the IPO. But it's not a straight shot to get there. And that's what we're digging into in today's Stocks in Translation. First, let's walk through the rules because they really explain the entire game. So here we have both the NASDAQ 100 and the S&P 500 rules, the two index kahunas, and they have two very different philosophies. The NAS 100 is more like a checklist. You list, you trade, you check the boxes, and if you're big enough, you can get in relatively quickly. Right now, you just wait 3 full months. The S&P 500 is more like a country club membership with a credit check. It's not just are you big, it's are you profitable, and does a committee want you in the club, and there's a 1-year minimum wait. And the buzz around it is loud right now because there's also a new idea floating around NASDAQ land, and it's a fast track that could shrink the post-IPO wait time down to 3 weeks. But on the S&P side, there's no discussion of fast tracks just yet, and profitability, it's a hard gate. So fortunately for SpaceX, it will likely pass the 1-year profit test right out of the gate. But for the other two mega IPOs, OpenAI and Anthropic, they're almost certainly unprofitable, so they're likely a long way off from joining America's benchmark index. Now let's put some history on this. Here are some examples of big IPOs and how long they had to wait to join the S&P 500. Take Meta, then Facebook, and Alphabet. They both got in fast, about 1 year and 7 months. That's the clean version of the story. Big, liquid, established businesses, and the market got comfortable. Airbnb took longer, almost 3 years. Uber took longer still, over 4 years. Why is this? Because sometimes a company is huge, but the path to consistent profit, that's what matters for the S&P. Palantir is a good reminder that this isn't only an IPO story, that was a direct listing, and it still took almost 4 years to land in the S&P 500. And then there's Tesla, Elon's first big public company. 10 years, 6 months. That one tells you that the S&P is not just about those day one IPO pops, it can be a really long game. Okay, so why do indexes build in a weight at all? First, price discovery. An IPO is a hype machine and a pricing exercise both at the same time. The index wants to see where the stock really lives when all the confetti clears. And second, a new listing has a thin float early on. A lot of shares are still locked up and can't be sold. So a little buying or selling, that can whipsaw the price more than usual. And third, these lockups change the supply of shares. And this is where you can get a sneaky price drop when the lockup expires, even if the IPO looked great on day one. And finally, index additions can distort, because when an index adds a stock, some funds have to buy it. Not because they love it, because their job is to match the index. And here's a great reality check from the definitive IPO trading book called The Life Cycle Trade. Kathleen Donnelly and the other authors found that 91% of IPOs eventually undercut their day one low, and 55% do it within 3 weeks. That's a great reason why the index weight exists and why you don't need to rush to buy these new listings. Now here's what to keep your eye on as these mega IPO stories evolve. Watch for developments on the NASDAQ proposal to shorten the time to index inclusion and anything similar from the S&P Index Committee, though it's unlikely those guys will budge. And then when these giants finally start trading, pay attention to the lockup expirations. When the early buyers are free to sell their shares, it's a potentially bearish event. And also keep an eye on the financials and the prospectuses and the earnings reports to keep track of when the AI giants might be eligible for the S&P. Remember, they need a year of continuous profits. And finally, watch for those announcements about getting added to the indexes, because stocks will often get a nice bounce when the press release drops, but by the time they are actually added to the index, a lot of times that bump fades. And tune into the Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. President Trump sending a tariff warning, writing in a social media post that any country that wants to, quote, play games with the Supreme Court decision will be met with a much higher tariff and worse. Here to discuss the tangled web of trade policy, let's welcome in Evercore ISI senior strategist Matthew Axe. Matt, thank you for joining us here. So let's start with that big decision. What do you make of it? Trump on social media today, kind of defiant as ever?
Yeah, look, I think it's a lot more volatility in many ways to end back up in a similar place to where we started. We've known for a while now that if President Trump lost in the Supreme Court on the IEEPA tariffs, he was going to quickly pivot to other legal tools to reimpose the tariffs. We've seen him already do that. There's been some slippage in terms of some of the details, but I think big picture, sort of from a macro standpoint, we're largely where we were a week ago.
Okay, what about some of these trade deals and investments that were already secured? Thinking about Japan, South Korea, and maybe a few others. Are those in jeopardy now?
Yeah, I don't see those deals as being in a whole lot of jeopardy. I think that, again, there's been some change to the details and some of the mechanics of the tariffs that now needs to be reworked a little bit. But I think those other trading partners know that if they start to violate the terms of the agreement, they run the risk that President Trump will come back even more harshly with other tariff tools. And so I think that for now, they're going to take more of a wait and see approach, see how this new kind of interim regime, where it ultimately leads. But if it leads substantively back to where we were, I don't see the deals being completely ripped up. Now, I will say I think these deals face plenty of other risks unrelated to the Supreme Court decisions. I think that the investment commitments that have been promised are quite large, and in some ways it may be hard to see all that money materializing quickly, but that's unrelated to the Supreme Court. I think for now, I think most of the major trading partners, again, are going to be in a wait-and-see approach.
And what about China, kind of the elephant in the room here? Does this change President Xi's leverage, for instance?
Yeah, it's very interesting. I mean, China actually gets a very small windfall here. Their IEEPA tariffs were at 20% prior to the Supreme Court. Now they're in the 15% global tariff regime. So they actually get a little 5% windfall in this kind of interim period while we're transitioning to new tariff authorities. I think that, both the United States and China have learned that they have tools to hurt the other. And I think, leading up to President Trump's trip to Beijing in April, I think the focus is going to be on kind of avoiding turbulence, avoiding another conflagration that sets off a whole host of new tensions, and trying to keep this fragile deal in place, or fragile truce, I should say, in place as long as they can.
And then thinking about the tariff refund process, I think the total is estimated to be $175 billion. How do you see that playing out?
Yeah, look, I think it's going to be a slow, messy, bureaucratic process. The question of refunds will now be remanded to the lower court, the Court of International Trade, to consider the issue. I do expect that the CIT will say that refunds are required. But then where things go from there, I think it's highly uncertain. The administration could challenge that judgment and have to go through another round of appeals around that judgment. The administration could also accept the judgment, but just make it very hard for people to go and get their refunds, create a lot of paperwork, create a lot of verification that's needed. So, and then you have, in the background of this, the politics. The refunds are due to the importer of record, meaning the person who actually took possession of the merchandise and brought it into the country. But we know that consumers paid a lot of the tariffs in the end when prices were passed through. So I think there's also a political issue about paying these refunds out to the importers when we know that households bore a lot of the incidents. And I think that's something that you're going to hear President Trump and Congress talking a lot more about over the coming months as this whole refund story unfolds.
All right, let's shift gears a little bit to geopolitics. We've got Iran in the news, WTI crude oil jumping to a 6-month high after it seems there's a bit of an escalation. And anytime the Straits of Hormuz, where I think 25% of the mobile oil supply passes through any given day, anytime that's mentioned, we see prices jump. Maybe that's a little bit extreme, but how are you game playing this out?
Well, I think with Iran, we're clearly in another classic Trumpian escalate to de-escalate cycle. We've seen this a whole host of different times in both the trade and geopolitical realm. Right now with Iran, the kind of massive mobilization of military hardware into the region is clearly signaling we're still kind of in the ramp up on the escalation cycle. But I think President Trump at this stage is still keeping his options open. I think negotiators are supposed to get together again on Thursday. I think President Trump kind of instinctively would prefer a diplomatic off-ramp if he can find one. I think instinctually he's not super keen on having a big open-ended war in the Middle East. Especially at a moment you show the gas prices, the oil prices, especially at a moment where consumers are very focused on affordability, and you could see a feedback to gas prices. So I think Trump at this point keeping his options open. He may have to do something kind of a limited nature, strike something to show that he's serious, and that'll take us even one step further up the escalation ladder. But I do think ultimately we are back in the escalate to de-escalate cycle, and President Trump does not want to do something that ultimately unravels the whole situation and makes a war in the Middle East the story of his term.
And President Trump will be getting the center stage Tuesday night with the State of the Union address. What do you expect him to say about the economy and some of the issues that we've been talking about here?
Well, there's the speech that the White House speechwriters are going to load into the teleprompter, and then there's the words that are actually going to come out of President Trump's mouth. We know he loves to go off script. I think the speech, if it goes according to plan, it'll focus on the big, beautiful bill tax cuts, which folks are going to start to feel very soon here through the tax refunds. It'll focus on President Trump's efforts with the pharmaceutical companies to lower prescription drug prices. He'll probably talk about affordability also when it comes to energy, when it comes to housing, and try to sell his kind of economic story and economic message. Now that's sort of the game plan, and I do think you'll see a decent bit of that. But then there are going to be some wild cards, right? I think, getting back to the earlier point, does Trump want to use it as a moment to try to send a signal to Iran about how serious he is? That's possible. The Supreme Court justices will be in the front row. Does Trump want to send a message to them about what he thinks about their tariff decision? So I think there's kind of the base case, which is around economic policy and very focused on the sort of affordability narrative leading into the midterms. But we know with Trump, it could go any number of different directions.
Yes, Matt, a lot to chew on there. Really appreciate you breaking all of that down for us. Thank you.
Great. Thanks for having me.
Time now for What to Watch, Tuesday, February 24th. It's a busy day for markets with politics, earnings, and tariffs all in focus. President Trump is delivering his State of the Union address Tuesday, the speech coming amid heightened partisan tensions with a group of Democrats planning to boycott and hold a rally outside the Capitol. Investors will be listening closely for any commentary on tariffs, Trump imposing a 15% global tariff after the Supreme Court struck down a big chunk of his tariff agenda. On the earnings front, another big week ahead with Keurig Dr. Pepper, Mercado Libre, and Alcon all reporting. Retail is in also focus with Home Depot announcing fourth quarter results. Analysts expecting same-store sales to edge lower, but winter storms may be providing a temporary boost in do-it-yourself demand. Another focus will be 2026 guidance with expectations for flat to modest comparable sales growth as the home improvement market stabilizes. On the software side, Workday is also reporting Q4 earnings, the stock getting hammered in the recent software sell-off. But the spotlight may be less on the quarter and more on strategy as the Workday co-founder resumes the CEO role. We're also getting fresh commentary from Federal Reserve officials on Tuesday. The market's continuing to weigh the impact of inflation on tariffs and bracing for what President Trump will say during his State of the Union address. And finally, February consumer confidence is released Tuesday. Economists forecasting the headline number to come in at 87, up from January's print. And that's going to do it for today's Market Domination Overtime. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all of your coverage leading up to and after the closing bell. But don't go anywhere. On the other side of the break, it's asking for a trend. Stay tuned. Hello and welcome to Asking for a Trend. I'm Jared Blickery, and for the next half hour, we're going to be breaking down the trends of today that'll be moving stocks tomorrow. The fallout of the Supreme Court's ruling on tariffs. We're taking a deep dive into the retail sector and who the winners and losers are going to be. And the sell-off on Wall Street was broad-based today, beyond stocks, crypto, and also coming under pressure from the sellers. We're taking a closer look at the moves in Bitcoin. Plus, the AI tech trade beyond tech. We've got the investor playbook when it comes to electricity right ahead. And it's been a busy weekend. The Supreme Court striking down a major piece of President Trump's trade agenda, Trump then making a 15% global tariff announcement within 24 hours. Investors trying to figure out what this means across sectors, including retail. For more, we're bringing in Max Kahn, president of CoreSight Research. Max, thank you for joining us here. So let's start with the tariffs and the effect on retail trades. I mean, the tape was awful today, but we've got 4 or 5 different things going on. So kind of tease it out for us here.
Yeah, I mean, I think that, with tariffs specifically, I actually think that there's definitely some reaction to the administration's, moves over the weekend relative to reinstating some tariffs. But we actually feel like retailers have done a really good job over the past year of building more flexibility and resilience into their supply chains. And so we actually think that, sort of tariff changes is becoming a bit more of a business as usual sort of uncertainty. I mean, it certainly at this point is not settled in. There's still a fair amount of uncertainty regarding where all this is going to settle over the next 3, 6, plus months. But with that being said, though, I think retailers are in a much better place right now than they were a year ago, because they understand that this may never settle in, or that there could potentially constantly be changes. And they've started to really, build more flexibility into their supply chains to address that.
a permanently high plateau in volatility and uncertainty. Really interesting to think about. You mentioned supply chain a couple of times, and just give us an overview. How reliant is the U.S. still on China and some other countries? How far along are we in the president's goal of bringing a lot of that back to U.S. shores?
So we're a lot less reliant on China, that's for sure. But the shifting away from China has not necessarily moved back to the United States. So most of that shifting has moved into other parts of Asia, into South America, into other part, into even to a lesser degree, but a small and emerging degree to Africa. So the reliance on China is definitely down, but that hasn't necessarily, driven manufacturing for the retail sector and back into the United States yet.
Well, we've seen winners and losers in retail writ large, and this goes all the way back to the pandemic. So what kinds of retailers are best positioned to navigate the current tariff backdrop, given that, we are probably going to have a lot of uncertainty for a while?
Yeah, I mean, I think really the number one thing I would look for is the companies that have built-in resilience and flexibility into their sourcing strategy, and you can kind of see that a little bit more relative to whether a company is able to, sort of shift their sourcing depending on exactly kind of what the current situation is. So a lot of people were able to, to kind of shift away from China, but I would look for companies that are not highly concentrated in any one particular country in particular, and that have diversified their ability to do sourcing, not just into different countries, but into different regions as well.
When you survey consumers, how concerned are they exactly about tariffs, or is there some kind of tariff fatigue going on and it's just not on their radars that much anymore?
Yeah, it definitely is not on their radar as much as it was. We've kind of seen that, a fair amount in the back half of last year. I mean, I would say that consumer sentiment overall, we do a weekly consumer tracker, and our consumer sentiment has been trending up. We do a survey every Monday, so we will have information as to whether this is whether there sort of was a spot flash change to sentiment that occurred literally over the weekend, but unfortunately that survey is literally in the field right now, and so we don't have that data yet. But we definitely did see kind of consumer sentiment starting to ease back up a little bit, at the beginning of this year, and we're kind of waiting with bated breath to see if that continues or if this does change. Our expectations are it probably won't be nearly as big a shock as things were a year ago, because I think there has been some tariff fatigue that's going on in the market.
Let's shift gears to AI. We got more AI scare news over the weekend. It hits software, so we're not necessarily talking about retailers that got hit because of it, but of course it's front and center in a lot of investors' minds, and AI can be a force for good too. So tell us about how the AI is changing the landscape in retail.
Oh, well, we think that there's tremendous opportunities for retailers to leverage AI, and we actually think that those that are at the forefront of that are going to have a real advantage, and will probably, be able to drive and be more, you'll see a lot more of the winners in retail based on the ones that are embracing AI. We see the opportunities in terms of running their supply chains, their store operations, as well as the way they engage with their customers. I think the smartest ones have been a little bit more aggressive using it in their own internal operations, because they have a lot more control over that, and are being a little, more methodical in how they're rolling it out to engage with consumers. But you certainly see engagement with consumers starting already with things like, customer service chatbots and things like that as well. So to us, one of the ways that retailers are going to be able to expand margin in sort of in an environment that's very competitive, where pricing pressure continues to push down, where you continue to have pressure from Amazon, and to maybe to a little bit lesser degree, but certainly continued pressure on pricing from Temu and Shein. One of the ways that companies are going to be able to be successful is by expanding their margins in a world where they're not going to have as much success in raising prices.
Something to chew on here, and we will be waiting for that next consumer sentiment report. Thank you for joining us here today, Max.
Absolutely. Thank you for having me.
You bet. And stick around, much more asking for a trend still to come. Crypto struggling once again after a fresh injection of global trade uncertainty. Yahoo Finance's Ines Ferre joins us now with a look at the latest action. Ines, pick your poison. We got a lot of catalysts today. Tell us about the crypto front.
Yeah, that's right, Jared. If we take a look at Bitcoin, it is now down about 47% from its all-time high peak back in October. Year to date, Bitcoin is down 27%. Ether is down even more, 37%. So overnight, we saw quite a bit of price action to the downside. We saw Bitcoin going down below 65,000 last night. And in part, this is because of the tariff uncertainty and what investors were really going risk off. They have bought up precious metals, but Bitcoin didn't get that bid. Again, reinforcing what we have heard over the last several weeks, that Bitcoin has really failed to be that sort of digital gold, so to speak. It's been trading more like a high-risk tech stock. Now, 2 points I just want to make. One is that there isn't much of a surprise on the street about this move to the downside, because you've had even the most bullish analysts that have been talking about expectations that you would see Bitcoin going lower. There's some calls out there saying that it could go as low as 50,000 per token before rallying in the second half of the year. So it is still in a downward trend, and analysts were expecting it to go lower. The second point I want to mention is that the severity of this bear market, Ed Engel over at Compass Point wrote a note about this bear market that crypto is in right now, and basically comparing it to 2022. And what he's saying is that there hasn't been this big bust of lenders, of prime brokers, the way it was back in 2022. There was one earlier this month, but compared to others in the space, it's not that big of a mover. So basically what he's saying is that this bodes well for the sort of longevity of this bear market. Is saying basically that it's not going to be as severe, in his view, as the one in 2022 because of that very point. But certainly not great news for investors that have been buying the dip, so to speak, as the token has been going lower.
No, maybe not as bad, but 50,000, that is quite a bit lower from here. Thank you for that, Ines.
Thank you.
And stick around, we got much more asking for a trend still to come. AI is often framed as a semiconductor story, but there's another trade quietly gaining momentum underneath it all: energy. Josh Lipton spoke to Rob Thummel, Senior Portfolio Manager and Managing Director at Tortoise Capital.
Let's start bigger picture, Rob. Okay, I want to talk about the energy sector, which of course you know so well. You look at the XLE, Rob, I mean, this thing is already up some 20% this year. Smokes the broad gauge, of course. What do you make of that? What explains that? Does it continue, Rob?
Yeah, thanks, Josh. Good to see you. So obviously we're happy to see what that investors are interested in energy again. And you know what's driving energy and why is the XLE outperforming so well? It's because I think investors are looking for those sectors that provide some high free cash flow yields, that operate assets that are really difficult to replicate and that are essential. And where do you find those? You find that in the energy sector. And so you layer onto that the energy sector is probably cheaper relative to other sectors in the S&P 500. Well, that's then led to this outperformance to start the year, and it's of course been bolstered by the fact that oil price has been up a little bit as well. But long story, we think that can continue. These free cash flow yields and energy will continue to be there and probably grow, and so that really represents an opportunity to continue to invest across all of the energy sector.
One trend, I'm just curious, I wonder whether you think this helps in part explain some of the story, Rob, that perhaps investors right now are ducking into names that they think, okay, this is a name. I don't think an AI chatbot is going to blow up. I don't think OpenAI or Anthropic is going to blow this name up. It's what my buddy Josh Brown is calling halo names, heavy asset, low obsolescence. His point being, Exxon, he says, is a halo name, right? Exxon has had a run this year. What do you think about that investing theme, that trend? You think that's playing some kind of role?
Yeah, Josh is a really smart guy, and I've seen him refer to that as well, and I think he's right. I mean, I think it just relates to the necessity of these assets as well, right? You really need these energy assets, and so I think that's part of that theme, and I think that trade continues and can continue to be successful for an extended period of time, especially if AI is this next industrial revolution. It's going to make these energy names even more important.
Let's talk oil too. I got you, Rob. I got WTI here at 66 and change. You've been watching the headlines, geopolitics front and center, tensions ramping up between the U.S. and Iran. I'm just curious where you think oil heads from here, near to intermediate term.
Yeah, I think the futures curve, Josh, has got it pretty right. We're going to stay in the $60 to $65 range. Yeah, there'll probably be there, and there already is a little bit of an elevated geopolitical risk premium now that's kind of worked its way back into oil, probably $5 or so. Look, we'll see what happens with Iran. I really don't think that Iran's going to do anything in the Strait of Hormuz. But if somehow they would, if they would block it for an extended period of time, oil would go well above $100. We don't think that that's going to happen here at Tortoise. Could oil be disrupted or the infrastructure be disrupted? Maybe, and if that happens, then maybe you see oil add another $5 to $10 of geopolitical risk premium. But generally speaking, we think the oil prices can remain right where they are in the $60 to $65 range, and that's a pretty good price. It keeps gasoline prices below $3, keeps consumption and demand pretty strong as well, and the producers can earn a decent return at this price level.
I think I've heard you say, Rob, correct me if I'm wrong, electricity, I think you framed it as like the new oil now. Let's put some numbers on that. I mean, electricity demand, you think it grows by what, Rob, over 1, 3, 5 years? And do you think investors perhaps, maybe they don't appreciate that trend as much?
No, you're spot on, Josh. It's still electricity demand is still an underappreciated story, and we've been identifying that here at Tortoise for a while. You're right. We describe it as electricity being the new oil, and what I mean by that is, if we're going to an AI-driven economy, if we're going to AI being the next industrial revolution, what does AI need? It needs electrons. Electrons need electric generation. Electric generation needs infrastructure, and so yeah, that's what we expect. And so then, what does that mean in terms of demand? 2 to 3% annually of growth in electricity demand. And when you start compounding that over a series of decades, that's a lot of electricity.
So one way to play that big trend, you say Constellation Energy. Why is that a buy, Rob?
Well, Constellation is, it's one of the largest independent power producers in the U.S. It's some of its electricity generation facilities are located perfectly with where we're seeing this demand for data centers, like in Data Center Alley in Northern Virginia, in Texas. Constellation is actually also the largest producer of nuclear power, right? And so nuclear power is going to be really important going forward as well, because nuclear power can be one of the lowest cost power solutions. And so if we're going to generate all this electricity in the U.S., win the global AI race, which I think we're going to do, we're going to have to do it with low-cost electricity. The U.S. has a really good opportunity by using its nuclear power, its natural gas, its solar, and its wind, as well as hydro, and maybe even a little bit of coal. And put all those together, the U.S. can win this global AI race.
A relatively lesser-known name, but one you like, Cameco, Rob. Talk about that name, their role in this broader investment trend. The stock is a monster. It's up about 150% over the past 12 months, Rob?
It is. Cameco, though, is a leading uranium provider, right? So what is uranium? Why is that involved? Well, you need uranium to generate electricity from nuclear facilities, right? And so we think nuclear is so important, Josh, that here at Tortoise, we launched the Tortoise Nuclear Renaissance Active ETF recently, and Cameco is one of the leading names, or one of the top allocations in that particular active ETF, because it has some of the best mining opportunities in uranium. And in addition to that, though, they're growing their contract base basically along with their uranium production, and these are long-term contracts. So they're not a commodity play. They're actually more of a play on electricity demand going forward and AI going forward as well. And so we think investors can stealthily get into a company like Cameco and other nuclear companies, as well as natural gas companies, by if they're wanting to play the AI theme, but they don't have to pay the mega cap tech multiples.
You mentioned natural gas there. Also, of course, plays an important role in this big theme you're discussing. EQT, still the way to play it, Rob?
Yeah, I don't know if you saw yesterday, but the Commerce Department announced this massive natural gas power plant, probably the largest one in the U.S. that potentially will be built in Pennsylvania. It's effectively in EQT's backyard. Actually, it's in Ohio. I meant to say it's in Portsmouth, Ohio. Who's going to provide the natural gas? Well, it's going to be the Marcellus Shale. And who are some of the largest producers in the Marcellus Shale? Well, EQT. And EQT and Toby Rice and the team have done a phenomenal job there since taking over of allocating capital, producing more natural gas when it's needed, slowing down production when prices go lower. And so they've done a phenomenal job of managing the company. And we think that EQT will be one of the benefactors of the long-term demand for AI and the role that natural gas will play, which will play a really important role in providing the fuel supply to generate the electricity that generates the power and continues the development of AI development.
Rob, as always, great to have you on the show. Enjoy the weekend.
Thanks, Josh. You too.
And that is a wrap for today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern Time for all the latest market-moving stories affecting your wallet.